I think in the near term, our technical strategist Mark Newton thought we could be seeing 4,000 before the end of the month for Ethereum, but that's not where it peaks. He just thinks that that's the first target. And then I think something, if Sean Farrell's math is correct, then I think 10 to 15,000 actually makes sense too.
By the end of the year?
It could be end of year, it could be sooner.
As Wall Street and AI converge with blockchain technology, Lee emphasizes that we are entering a new era of programmable money and decentralized finance. With global liquidity cycles shifting and institutional sentiment changing, crypto isn't just another market. It's becoming a leading economic indicator. Bitcoin, positioned as digital gold, is regaining momentum as a trusted store of value, while Ethereum's smart contract infrastructure opens the door for real-world utility and scalable applications. As central banks potentially move toward easing and the financial world digitizes, Lee argues that we're seeing the early signs of a historic shift. This isn't speculation, it's the groundwork for a new monetary system, and understanding this landscape could be critical for long-term investors.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
We're still adamant fans of Bitcoin because to me, Bitcoin is, first of all, it is really the ultimate form of trust at the moment, and it is digital gold in an easy way. And if someone says, well, what does that make it worth? Well, gold's 22 trillion network value, so Bitcoin should be worth $1 million. And there's plenty of future businesses that can be built around Bitcoin because of its stability. Ethereum is a smart contract enabled platform, and so it is unique because you can actually store real things onto the blockchain, whether you use layer 1 or layer 2. And I think maybe the real killer app, and this is what stablecoins are showing, is that as we move into a world of like AI and we're trying to create units of pricing and to simplify the movement of goods and things, simple examples of like tokenizing things from the real world onto a blockchain, you couldn't do it really on Bitcoin because that's not what Bitcoin's designed to do. So I think as you're thinking of Wall Street converging onto crypto and then AI innovations taking place and the idea of using even tokens or stable coins around that, well, then that's really when it comes to saying, well, Ethereum really is the largest smart contract platform in terms of network value. And that's what makes it attractive. I generally agree with people who say crypto responds to global liquidity. And so if central banks are easing, then we should see it in crypto prices first. And that's why crypto actually is a leading indicator for the stock market. And the fact that Bitcoin broke out to all-time highs is actually bullish for the S&P. But the interesting thing is that crypto is still not that widely held. So I think that, Bitwise has a great stat. They say 95% of Bitcoin's been mined, and only 95% of the traditional finance world doesn't own Bitcoin. So there's a real mismatch. And so I think Bitcoin continues to be the leading crypto asset to watch. But to us, as risk appetite recovers, Ethereum and small caps are pretty highly correlated. And I think that that's why Ethereum, in percentage terms, has more upside for the next few years. Sean Farrell is the head of digital assets research, and he's given me some informal sort of targets. One way he thinks of this is that if we look at Circle and its free cash multiple, which now is like 130 times EBITDA, on an equivalent basis, Ethereum is closer to 15,000. And that makes sense. I think the layer 1, as you get into layer 1, you should apply a higher multiple to like sort of theoretical usage because it's the same reason software companies get higher multiples than retailers, right? The more you're getting away from the customer and the more it's pure signal, you apply higher multiples to that business. And so I think in the near term, our technical strategist Mark Newton thought we could be seeing 4,000 before the end of the month for Ethereum, but that's not where it peaks. He just thinks that that's the first target. And then I think something, if Sean Farrell's math is correct, then I think 10 to 15,000 actually makes sense too.
By the end of the year?
It could be end of year, it could be sooner. I mean, it just really depends. But that wouldn't be the cap, but that just shows you that's really a level above 5,000, it would be a decisive, all-time breakout for Ethereum. So I think that's a significant level to watch as well.
Tom Lee underscores the technical and fundamental strength behind Bitcoin and Ethereum. Bitcoin, with its 1 million plus long-term valuation logic based on gold's $22 trillion market cap, is still held by a fraction of traditional finance, signaling immense upside. Meanwhile, Ethereum, as the largest smart contract platform, has potential price targets ranging from $4,000 short-term to $15,000 by year-end, based on cash flow models similar to high-growth tech stocks. Ethereum's utility in tokenizing real-world assets, powering stablecoins, and enabling AI integration makes it uniquely positioned for dominance in the digital economy. Stablecoins in particular represent both opportunity and threat to legacy finance, forcing institutions to adapt or risk irrelevance. The crypto market's sensitivity to global liquidity, its role as a leading macro indicator, and the mismatch between adoption and supply reinforce its explosive potential. Ethereum may outperform in percentage terms, but Bitcoin remains the macro bedrock of the crypto space.
Well, I've been paying a lot of attention to earning. We're in the middle of earning seasons, and financials start to report in earnest. Well, this week and next week, but there have been a lot of comments from these financials about stablecoins, and stablecoins are frenemies for the financial industry. So I think that's just something people have to watch out for, because they are both a opportunity, but it's also a threat to their legacy business. So you have to keep in mind that in some ways, the financial industry is one of the strongest and savviest lobbying groups, that they have a role in how crypto regulations can pivot in either direction. I can give a simple analogy, and then we can think about how it applies to the financial sector. But, let's take social media and Facebook. And let's say Facebook was the cash cow for Facebook, which it is for Meta. But then came along Instagram, which was a very different way for people to interact. And then TikTok came along. And as you know, TikTok completely caught Meta by surprise. And if Meta had only invested in Facebook, the company would be a dwindling business. But they, of course, correctly made the pivot both to WhatsApp, Instagram, and then to TikTok, with Reels, etc. Well, in financial terms, the banking industry has not necessarily been that quick to recognize that an increasingly digital world means money is increasingly purely digital, and it's actually breaking barriers, And then if we look at the next iteration, it probably blurs what is the definition of money. We've already seen that blurring with loyalty points, etc. And so banks make a lot of money from traditional financial systems. It's 4% of global GDP is earned by the banking system. And whether you look at interchange, Visa earns 2 to 3% for being in the middle of a merchant transaction. These numbers drop dramatically in a digital world where trust is established through the actual blockchain itself. So that's what we have to realize is what is like the TikTok moment for Facebook.
As Tom Lee concludes, the broader financial system is facing a TikTok moment, a disruptive inflection point where old models are being rapidly replaced by digital native innovations. Just as Meta had to pivot from Facebook to Instagram and Reels, banks must now navigate a world where money is becoming code, trust is decentralized, and intermediaries are being replaced by protocols. Blockchain technology erodes the margins of traditional finance, from credit cards to SWIFT, and the implications are massive. The 4% of global GDP earned by banks is under threat. With Bitcoin providing immutable trust and Ethereum driving programmable utility, investors must recognize that crypto is not fringe. It's foundational to the future of finance. For those watching closely, this is the time to pay attention, reassess, and reposition. Whether you're an institutional investor or a curious observer, understanding this transformation could be the edge you need in a world shifting toward decentralization,